Welcome back. Here with us, just a quick check on the market before we move on. And the cut is still very much there. The Bank Nifty down about 1%, and the Nifty itself is negative. The mid-cap index, that little flare that we had just around 915, 920, at least at the index level, that has worn off. So it's a pretty somber market that we are looking at. Well, let's move forward to our next conversation. Zydus Wellness has raised about 650 crore rupees via a QIP issue. The pricing was about 1,690 rupees per share. SBI Small Cap Fund, Aditya Birla Sun Life, ICICI Pru, SBI Mutual Fund and HDFC Life were some of the main investors. Tarun Arora, CEO at Zydus Wellness, is joining in to give us some more color on this. Tarun, thanks so much. Good morning. Thank you for joining us today on the show. First of all, if I could understand this QIP, I mean, is it funds coming into the company or was this an exit for an investor? And if it's funds coming in the company, then what will they be used for?
Good morning. It's my pleasure being on the show. The reason of doing these funds is to deleverage our balance sheet. We had non-convertible debentures, which we had taken at the time of acquisition, about 1,500 crores. So we are looking at part of it being retired and converted into equity. About 1,000 crore, because there is about 350 crores of preferential issue which has happened to the one of the promoter groups, and 650 crores out of this QIP. So 1,000 crores can be reduced from the debentures. So
can you tell us the overall debt position then? What does it come down to now, aggregate level, and where does it take your debt equity ratio?
So right now, before between these issues, we were at about 0.44 debt equity ratio, and we're looking at, with this 1,000 crores, our effective debt will remain at 500. We may use certain additional funds from our cash to further reduce it, and remaining we will do it over a period of time because we have cash, we are generating cash. So we'll take that call as we go along with the guidance of the board.
Okay, so you have about 1,500 crore debt, and that will come down to 500 crore. That's how you're mostly using the money?
That's
okay. And what will be the equity dilution because of the issue?
So effectively, the promoter shareholding will come to, as a group between CHL and Cadla, and as well as the family trust, will come to closer to about 64%. And so that's really what it is approximately. And we'll have about 6.3 crore shares at overall level.
You have plans to pay off the entire debt?
So eventually, I think our intent is to be completely out of debt. But the remaining will happen over a period of time through our internal cash accruals. We have a good cash flows from our business. So remaining will happen through our internal cash flow.
Well, technically,
so next 1.5 years period of time.
Okay. Your product Complan also is should have benefited a lot with the recent preoccupation with health. How was the second quarter for Complan and for the company in general?
So first quarter, I think we've done fairly well across some of our essential products, where April was extremely hard, and by June we saw a good recovery, in fact, double-digit growth. This quarter, again, we are, as an organization, we believe we will continue in our growth ways, because I think the worst is behind us. And hard to predict. There is a certain amount of volatility, but our essential products like sugar-free Complan will continue. Nycil sanitizer, some of these products will remain fairly relevant in these times. So Complan and sugar-free are both of our products continuing to do well in this scenario. And we're quite positive on their performance going forward. Some of the brands which were struggling and got more impacted during the COVID times, brands like Nutralite, which had a reasonable share of food service business, now they are also progressively getting better. There's a discretionary purchase in the personal care, which was brands like Everyouth. They have again got recovered fairly well. The seasonal brands are more quarter 4, quarter 1 kind of brands, which is Glucon-D and Nycil. Other than the lockdown, serious lockdown of March, April, I think they have been recovering fairly well, because they are fairly essential in nature, routine products. there the season plays more important role, and Nycil we've seen consistent good performance. We've also used this period to focus on innovations, because there were opportunities where our portfolio fitted into this scenario. So we went ahead and launched the Nycil sanitizer. It was probably one of the first extension in 65-year history of Nycil. So that, and there are more. Glucon-D, we launched Immunovolt, the Energy Bites, which is vitamin C, D, and zinc. So it has an immunity platform. So we have quite a few products in our portfolio which fit into this, new normal, if one were to say. So we're quite positive about things as they shape up. Of course, the challenge of the environment remains. There is volatility, both from a consumer spending concern perspective, as well as the fact that there are, the level of infections has again seen moving up. Some local lockdowns will happen. So we're fairly conscious of that, but that's something we take into stride, and we're prepared for that.
Fair point, Tarun. But I guess what works for you is that most of your products are right up there, high recall, they're top of mind when it comes to most of your consumers, which are in urban cities. So if you could give us some sense on top line. I mean, first quarter was obviously down for obvious reasons, but as we go through the year, and also it's a very competitive market. I mean, you're up against some very big brands from some of your rivals, your peers. So will it involve higher marketing spends? Because while everybody is promoting health products, you have to fight for mindshare as well, right?
Sure. So let me break it down in terms of how do we see this year going forward, and then also talk about our spends. So to my mind, like I said, for this year, the worst is over, and we expect to grow from here on. And despite keeping volatility in mind, my own view is that we will continue to progressively get better. Our task is really to grow our categories. If you look at, with the exception of Complan, all our categories, we are the market leaders. Our task is to grow categories. They're quite essential in nature. So we are very focused on what is the right thing for the consumers and how do we build those categories around. And given that background, if you look at the history of Zydus Wellness, we've been one of the largest spenders. If you look at advertising to sales ratio, our investments have always been high. So I don't need to do something disproportionate or step it up suddenly. I've been balancing on how we spend on our brands, given the P&L pressures in the last quarter. Going forward, I think we continue to invest behind our brands, focusing continuously on growing the categories. Yes, there is increased competition. Some large players are coming in. I think more competition is going to be good for us, because the big task right now is to grow the categories. The penetration levels across our portfolio are still much lower. And if some of our competitors were working along with us in growing the category, I think that's a better opportunity as I see it.
See anyone say
we really
that?
know how to protect our shares right now.
Got that, Tarun. Got that. I mean, I've never seen anyone saying that competition will be good because it'll expand the category. I take that point. You've reached your 1740 goal that you set yourself. I mean, you've doubled your revenues faster than perhaps the street expected. What's the next goal? Can you grow at this frenetic pace?
So I think looking back at how we've really looked at Zydus Wellness over the last couple of years, and how do we see next 3 to 5 years, was when we put the whole two businesses together. Our task was to use this integration to build ourselves for what we really want to be in 3 to 5 years time. So we have looked at two parts. Use this to build to lower our cost structure, optimize our cost structure. Second is to be more future ready, both from sales and distribution perspective as well as the back end. So if you look at it, we've been able to double our, we're through this process, we're doubling our direct distribution reach. We are increasing our, capability at the back end. So all this is coming together to build the right future. And for us, the future will be that when we can grow ahead of the industry norms, we are looking at a good double-digit growth over the next 3 to 5 years, so that we can double our business and do it in a very profitable way. My commitment to all the shareholders has been, in most of our meetings, has been over the next 2 to 3 years, we should be getting back to crossing our 20% wish list of our EBITDA percentage to sales, because that's really what makes this business so exciting, that it's a profitable business, grows faster, we are category building. That's really where we want to be. A well-disciplined market leader in all the categories we operate in.
Got that. Tarun Arora, thank you very much. You have a lot of helpers of sugar-free, I guess, is now national food, given that we don't get enough exercise. So I guess you have a good thing going. Thank you very much, Tarun Arora.
Thank you.
For
It was
joining
my
us.
pleasure.
Okay, we have to get back to the markets because it's in a tight spot. Anuj.